Early stage founders must be diligent about our financing growth and need to be aware about all funding options. Founders are looking for ways to finance their growth with non-dilutive capital options and extend their runway for their equity raise. Today, we have with us Sanjeev, who will be moderating. Sanjeev is based in Minneapolis and is part of JPMorgan's tech and disruptive commerce banking group, actually the vice president. He and his specialized bank team helps high-growth companies, founders scale rapidly, operate efficiently, and capitalize on growth by leveraging JPMorgan's global product capabilities. So please welcome Sanjeev, and this is a really special session. Thank you.
Thank you. Welcome, everyone. Nice to see you, everyone here, especially on a beautiful venue. You know, you look outside, I've never been up here, so nice, great place to be in. Thank you, Beta, Minnesota, for giving us the opportunity to chat with you about some of the funding options that are available to early stage companies and making sure how you don't get diluted. I think that's the biggest thing, that as early stage companies, need to get some education and see what's available. I know the session earlier than this, they talked about some ways how you could potentially protect yourself. A couple ideas were client being one of your funder, and then on the panel we have two of my colleagues that I work with. Patrick Judge from Camber Road. He's a managing partner at Camber Road, based in Minneapolis, works with early stage companies. And on the web, we have Jimmy Steven from Brex, all the way from Salt Lake City. So welcome, Jimmy and Patrick. But before we move forward, Patrick, do you want to introduce yourself briefly about you and your company? What do you guys do?
Sure. Patrick Judge, partner at Camber Road. We provide non-dilutive capital to emerging growth companies in the form of lease financing. So we like to work with companies that have to buy things. Those things can be office desks, chairs, robotics, 3D printers, production line equipment, packaging equipment, basically capital-intensive businesses. And we work with companies, everything from pre-Series A all the way through later stage post-IPO businesses. We have offices here in Minneapolis and New York City and work with customers all over the country.
Thank you. Jimmy, could you please introduce yourself?
Yeah, absolutely. Thanks for having me as well. I'm sorry I couldn't join you in person. So Jimmy Stevens, Director of Channel Sales here at Brex. We offer a few different solutions at Brex. So to start off, we offer business accounts, so free wires, free CH payments, free checks, as well as credit cards for startups. We do underwriting based off of cash balance and really have a product for any size company, whether you are a small one-person brand new company that just incorporated or 1,000-person company. So happy to be here and very excited to talk about some of the options we have here at Brex, including Brex Venture Debt.
No, that's thank you for that, and congratulations on the recent raise that you guys did, Jimmy. It would be interesting to see what you guys do with that $150 million that you guys recently raised. So before we get into this, I'm just wanted to throw to you, both of you guys, what does non-dilutive debt mean? What does non-dilutive mean to, from your perspective? Patrick, you want to go?
Yeah, sure. Obviously, as a business, when you're starting out, you fund the company through some equity fundraising. Non-dilutive capital would be anything that doesn't dilute your shares in the business. And it's not a supplement. I think it's really important to say it's not a supplement for equity financing, but it is very helpful in avoiding dilution because non-dilutive capital will help you manage your runway and achieve the milestones you want to hit before you go out for the next equity raise. So just something to think about as far as, when you hear the word non-dilutive capital, it's basically any funding that will not take ownership in your company.
Jimmy, anything you want to add to that?
Yeah, I think the only thing to know on top of this is a lot of companies, they are trying to weigh the difference of when they should or shouldn't do something. And in reality, usually you still end up raising at a later point, but it'll be at less dilution. And so that's kind of the only additional thing I would add in there.
And then a couple of ways, early stage founders could look at stuff is, participating in competitions. Like Mira last night awarded $250,000. So that's another way. Look for competition nationally, locally. See how you might be able to mitigate or get to that extra cash that takes you to that next level. Sometime, as earlier panel discussed, talking to your client base and see if they would, take some discount, give you money up front. That gives you another runway to take your product to that next level. Patrick, how early do you guys get involved with your companies, portfolio companies?
It's a good question. We, kind of have our own diligence process, and we look at companies as early as pre-revenue businesses, but that really kind of falls outside of the box. So you have kind of your box, what what you're comfortable with, but we listen to stories. We will entertain and try to work with companies and develop the relationship with them very early on. It matters to us who's on the cap table. It's important. We value the relationships we have that help us determine whether or not we will do something that's outside of our box. So it can be early, but most of the time it's in and around getting involved in and around Series A, and then having that relationship with them as they grow their business. Whether you get involved in B, A, or C, our whole goal is to help them avoid dilution along the way as they grow their business.
Jimmy, anything on your end?
Yeah, same thing for us. So right around that Series A is a pretty good time frame in terms of when we're looking to do that with Brex Venture Debt. Ultimately, you talked about how we just raised that $150 million to help companies from that standpoint. And so, yeah, Series A, where you start having more and more revenue is when you're kind of a better fit for this, because obviously investors want to still be able to invest through debt in a way that is going to be a less risky return.
So how do you work with, we have a lot of founders that I've talked to throughout this week at seed, pre-seed stage, and talking to saying, hey, what are the options we have? I'm like, how do you guys help? I'm like, me as a commercial banker, when they come to me saying, hey, do you guys provide debt? I don't provide debt, but what I can do is connect with folks like Jimmy, like Patrick. So I'm like, when they approach you, Jimmy, what's your way of building relationship? Because I'm like, how do you help some of the seed, pre-seed companies?
Yeah, great question. So Brex, right from the very get-go, really started as the first corporate credit card for startups. And so we wanted to get our foot in the door and allow new founders, whether you had no credit score and were an international founder and came to the US, opened a business, and weren't able to get into and give UI and get access to credit, Brex was able to help right off the bat with that. And so we built a community around this startup ecosystem, which has allowed us to really now build out this product for Brex Venture Debt and see how these companies have continued to scale and grow with us. So what I would say is, if you are really early stage, coming into Brex, being a part of the community and the environment is a great way to already be in contact with everyone within Brex and really get to know more about Brex Venture Debt and how that can help you continue to scale.
So I think, the whole idea of, surrounding yourself with advisors, even though they might not be able to write a check up front, they could connect you with folks. So, I think that's a great point, Jimmy. Patrick?
Yeah, I mean, we try to immerse ourselves in the local venture ecosystems throughout the country, and a lot of times if it's too early for us or we're not a fit, we have a ton of partners and relationships where we can help the company find the right solution. And we want that to happen because as they grow, they'll eventually be a potential fit for us, and it's important for us to develop that relationship along the way.
And that's the same thing for JPMorgan. A lot of people, when I talk to early stage company, they say, hey, why are you talking to me? I'm not big enough. Our play is, we could be a one-stop shop from a seed early stage all the way to exit, meaning IPO, or a strategic sale. And the way we help, not from a funding side, but more from a cash management treasury side, and then connecting people. So, early stage venture debt, what both of you guys are doing is risky. I'm like, what do you guys look for in a company, in a founder? What is that thing that you guys look for? I know there's financials, but what is outside of that?
I'll go first. So, we look at the management team. We do our diligence on the historical financials. We look at the liquidity that they have today, whether that's through from the last round, the cash that they have from the last round, or a new debt facility that they have. And it matters to us who's on the cap table. I mentioned that before, but it's good to see if institutional money has kind of vetted the opportunity. So all those things combined is kind of what our box is, but we will look at things that don't fit in that box sometimes because of all the other factors like team and so on and so forth, and market and opportunity. So it's similar to kind of other non-dilutive diligence processes that are out there, and it's really not that different for us. Since we're doing lease financing, we do look at equipment and what it is and how it fits in the overall scheme of that company's growth. So it's a variety of factors that we will look at.
Before I go to you, Jamie, I'm like, you guys are national. There are folks all over on the web right now. What part of the country do you guys play in?
We're all over the country. We have a lot of folks that are based here in Minneapolis and travel out to those territories, or during the pandemic, stay in touch with those local venture ecosystems, whether that's in the Bay Area, LA, Austin, Texas, Chicago, New York, Boston, DC, and the Midwest, right?
Yeah.
So we, especially here in the Twin Cities, we've tried to get more involved by sponsoring beta. So we're everywhere, and we're talking to everyone and looking for really good opportunities that we can help them grow.
Jimmy, to you, sir.
Yeah, I would second everything that was said there. The only additional thing I kind of add in is, what's nice with Brex in terms of when we're analyzing these different companies is we do take a look at cash burn as well. So being able to offer that deposits account where we can then ultimately see what your inflows and outflows are looking like, as well as your credit card spend. We also are able to help you save money in different areas through our AI platform. And so by analyzing that, we can see if the company is coming and asking for $5 million in venture debt, but you're burning $1 million per month. 5 months of runway, right? It isn't the best thing if you're not going to be able to raise in that next time frame. So one additional thing I would add in there.
And then, Jimmy, you guys are a national player disrupting the marketplace right now. You're also employee number 18 for Brex, and now you have, 1,000, 1,200 employees. How has the marketplace changed? How has the ecosystem for early stage startup companies has changed?
Yeah, really, really good question. So when I look at when we launched back in 2018, there wasn't really this world yet where companies were specifically just going after startups. And so we were kind of one of the first players in this space and helped kind of form and create that. And then obviously COVID hit in 2020, which changed the way that companies got the way that events were happening. It's awesome to see people are back in person right now. And so ultimately, though, right now, we've never seen more venture money going out, and especially at an earlier stage. So we see lots and lots of players coming in, making investments at those pre-seed rounds. and trying to get on the cap table as soon as possible. So I think later on in this, we might talk a little bit about that and when you should or shouldn't take capital earlier on. But that's kind of what we've seen as a change.
Well, since you brought that up, I'll go right there. I'm like, usually venture money is seen as expensive, but the question is expensive compared to what? Is it compared to equity? How much dilution you're getting? How much of your company you're giving away? Versus here is your interest rate that you're going to pay. So, do you wanna take that question as well, and then we'll go to Patrick?
Yeah, absolutely. So, this is something that everyone might think a little bit different about this, but one of the best reasons for raising, obviously, is to continue to fuel your growth, because without that money, you might not be able to get to the next level and ultimately then raise a Series A. And from a publicity standpoint, once you are able to raise, let's call it a $5 million seed round or $2 million seed round, people will see that. You'll be on the news. You're going to have really good publicity. You're going to start hiring people. There's going to be this buzz around that. And not only that, the employees within your company, maybe by that point, you're a 4 or 5 person company, and then you're going to grow to be about 20 employees. Those early employees will kind of help to build out the culture of what the company will become over the next few years. And so, I'm a huge fan of companies. Just like you said, it might be a high cost, but it also might be one of the best rewards you can have earlier on in the company.
Patrick?
Yeah, like I said before, non-dilutive capital it's not a replacement for equity financing, and to Jimmy's point, equity financing it's not just the capital that you're getting infused into the company, it's momentum around it, and it fuels the energy to grow the company going forward. What non-dilutive capital can do is help you extend the runway you get after you get the equity financing. And the question is, why do you want to do that? And the reason for doing that is so that you have the time to hit higher value milestones. Why do you want to hit higher value milestones? You want to do that so that you can get a higher valuation on the next raise. So whether or not you're going from Series A to B to C, runway extension is very helpful in avoiding dilution as you grow the company.
I'll just take a pause here and see if the audience has any question before we move forward.
We must have done a good job, huh?
I don't know. It's you and Jimmy. I'm just the face here, So, one of the other things, Jimmy and Patrick, I think from a banking perspective, what I see sometimes is, talking to founders, raising equity is good, but then trying to raise equity is two different jobs. You're a CEO of a company and you're a fundraiser as well. Versus, on a debt side sometime or the non-dilutive side, it doesn't seem to be having the same rigorous process. Can you guys provide any insights on that?
Sure. Yeah. I think there's a lot more non-dilutive options than there were, say, 5, 6, 7 years ago. And I think that similar to why you want to extend your runway, you could argue that it helps you focus on running the business more because you have that cushion. You're not constantly worried about hitting that deadline for the next raise because you have this cushion. So yeah, you could make the case that non-dilutive capital does help founders focus on the business. I don't know, Jimmy, if you kind of feel similarly about that, but.
Yeah, definitely do. The other thing I feel pretty passionate about is for employees that are at the company, right? There's two good things on both fronts there. So by raising debt, you're able to avoid the dilution not only for yourself as a founder, but also for the employees. And so as you continue to scale and grow the company ultimately is more valuable on a per share level. But also at the same time, once you do raise, there's a lot of us internally with the employees because let's say your stock goes from $5 a share to $10 a share. they see that, and it's kind of this, it's like monopoly money until you either go public or you have a tender offer or some sort of secondary. And so that allows internally a really good buzz, and people generally like to work for something, work towards something, and so raising is helpful there. But also by avoiding dilution with debt, your employees are also able to understand that, and this is something you should be open about probably within your company.
So, Patrick, can you give us an example of some of your portfolio companies where the fact that they took money from you, or or some kind of non-dilutive debt facility that helped them get to that next level?
Sure. So we're a generalist, and insofar as the markets that we serve, we're in all different verticals. For one that comes to mind, a fairly successful e-commerce company, we help them finance autonomous robots in a pick, pack, and ship environment for their warehouse. And it was very expensive, and the company had a fairly decent burn rate. And by having us come in and do that in a non-dilutive way, they were able to scale out the business. And by doing so, they avoided what would have been likely a lot more dilution before they raised. Let's say when we got involved, they had 18 months of runway, and then we helped them extend that in a way that allowed them to scale out the business before they went through their Series C raise. And those are the types of situations where non-dilutive capital really does its job. So similar probably for you, Jimmy. Those are the things that they're really fun to be involved with, and when you see the stories work out that well. So that's probably a pretty straightforward example.
Jimmy, any example that you would like to share?
Yeah, so AdQuick, one of our venture debt customers, I actually have a little quote here. So this is Matthew O'Connor, their CEO. My number one priority is growth, and speed is key for us. Brex provides additional capital that enables me to further invest in my tech, build out my team, and market my products without being solely reliant on that equity funding. So really it's help them to continue to scale and grow the company up until they're ready for their next race.
No, that a nice quote there. I'm like, one of the other things that we hear quite a bit from founders is, when is the right time? When is the right time for me to raise equity? When is the right time for me to do some of these debt options? I'm like, when founders come to you guys, what is some of the advice that you give them?
Timing is relative to each story, but the whole kind of focus on our panel is probably avoiding dilution. And so if you can take the time to a later date where you have to raise and afford yourself the opportunity to have more successes before you raise, that's optimal, because the more successes you have, the higher the valuation is going to be.
Jimmy?
Yeah, two things here. I've talked with companies that end up raising a really big round, and then between that round and their next round, they end up only using 10% of what they raised the first time. So ultimately, they took all that extra dilution for no reason. But it also was kind of like an insurance policy, right? You didn't know for sure if you were going to have that full product market fit that you were planning on having. So one thing to kind of think about there. The second piece of information is for a lot of the companies that we've actually done Brex Venture Debt with, they ended up getting that from us right after they raised their round. As same type of thing. It's there if they need it, and it's a cheap way of being able to access capital. And for us, we knew that they were the right fit for the product right then too.
So one of the other thing that I think a lot of founders worry about from equity versus non-dilutive option sometimes is covenants. Meaning, what are some of the things might be financial, might even be milestone-based covenants. So how do you guys, look at covenants in your deals?
Well, typically you'll find us selling against covenants because we offer lease financing, which we're not asking for extra liens on the business or any restrictive covenants that some other venture debt solutions might have. And so, and a lot of times our customers they already have a venture debt solution, which makes it easy to bolt us on for the equipment piece of the capital need. And by not requiring all these, type of covenants and what have you, or liens or personal guarantees or any of that kind of stuff, no fees. We basically can come in there, and a lot of times we get a carve out from the existing debt solution. So we can come in there in a complementary way that doesn't, mess up your other deals that you have going on.
Jimmy?
Yeah, one thing I would say there is one of our biggest competitions per se is we bring the deal to the table. We're willing to invest and give them the debt, and then ultimately they go to their board. And the board says, "You know what? We believe in you. We are just going to give you the raise that you want at that valuation," and they end up not raising debt. So, I'm not sure if that fully kind of answers what you're saying there, but I think in some cases around the covenants, because debt might be something that some of the board or some of the other investors that are on the cap table might not be as on board with, that might be something that we'll have to bring across.
And going back to Patrick, I think, we see ample times where, bank debt, if they're financeable, bank would take a portion of it and then try to supplement with non-bank lender like yourself and try to, give the founders of the company a lower weighted cost of capital, because that's a better way to do it versus trying to put everything on non-bank or everything on a bank, and it might not be feasible. So I think that's the best way to do it.
Yeah, and to our earlier point about there's a lot more non-dilutive options out there. I think it's a competitive space, and so things are negotiable. So I'd encourage you to negotiate those terms.
Just wanted to check in with the audience, see if any other questions pop up anywhere. Jeff, you have a question there?
That's perfect. I know earlier you all mentioned that a better fit are companies that are in Series A and forward, so Series B, Series C. What are some non-dilutive options for companies that are more early stage, or is that not an option for consideration?
I think there are options. There's grants. There's the prize money that are in competitions. I've seen that grown quite a bit. And those are free dollars, and I think to the extent that you can get your hands on them, in a pre-seed, stage, they're very valuable, and you should pursue those.
Jimmy, anything on yours?
Nothing to add on my end. One thing I have noticed that it's not necessarily avoiding dilution completely, but there's safe investments into companies where almost like a predetermined price is set, and so it kind of helps to avoid mass dilution up front. So that's one thing to look into.
And Jeff, I think the other option is there's state and federal government aids as well, like SBIR is a lot of early stage founders go that route. So there are some funding options available through state, local government as well. That might be beneficial to some of the early stage.
I'd also add that Series A, the definition of Series A has changed quite a bit, and it's different in different verticals. Seed, post-revenue seed stage rounds, you'll see that, and so it means different things to different people. Don't feel like you don't qualify is just the one thing I would kind of throw out there.
And I think talk to a lot of people. I'm like, a lot of founders are used to getting no's. And I think especially on the non-dilutive side, I think it's even quicker. And most of the time it's like, they're not trying to buy into you and try to, take something from you. It's more of like a consultative approach. So talk to as many folks, and they would be happy to make connections, even though they might not be able to help. I was talking to a company recently down here. They play in CPG space, and there are non-bank lenders out there. They would give you, 2-3% kind of 90-day financing, and that might be worth it because if you get $1 million order, that $1 million from this non-bank lender might take you to that next milestone. So there are options. Any other questions? So, Jimmy, I know you guys just raised the massive $150 million for a venture debt. What's the focus there? Who are you guys going to go after? What kind of checks you guys going to write? I think our audience here would find that interesting.
Yeah, absolutely. So, like I said, 150 million. In terms of the low end versus the high end, I would say $500,000 is kind of on the low end, which for some companies is the perfect amount to get them to that next milestone. And for a Series A, Series B company, they might need a few million. And so it really differs for what they're looking for and how the company's kind of set up. And in terms of applying for this, you can go to our website. We have so it's brex.com/venture-debt. And you can ultimately apply to see if it's a good fit. We'll reach out and we'll let you know at the end if you're not a good fit, what needs to happen for it to be a good fit. And so we definitely want to deploy this money and get in and help provide as much as we can to the startup companies.
Can you please repeat that URL? Thank you.
Yes, so it's brex.com/venture-debt.
And you said you would do Series A, B. You guys won't look at seed, pre-seed kind of thing?
So we will. Yeah, so it's not just going to be your Series A or Series B companies, but we'll take a look at the company as a whole and previous investors to ultimately make the decision on if this will be a good bet for us or not.
And the one reason I even asked you that, I'm like, does valuation play a role? Because I was at a panel yesterday, and some of the seed, pre-seed kind of VCs were saying, hey, we won't even look at until it's, $4 or $5 million in valuation. So I'm like, how do you guys manage that aspect?
Yeah, really good question. And, after this, I'm happy as well, anyone else that wants to reach out and get more information on here. Billy is the person on our team that ultimately runs all of this. So for people who are maybe like a little bit more early stage and not quite there, we have other types of resources that we use to help companies. And a lot of what we've built out too is trying to save companies money so they can start and grow their idea. We provide good content for them to be able to get connected with the right people.
Patrick, are you guys, anything else that we didn't touch? Do you guys have any other products that you work with earlier stage companies than Series A or B?
You can get in touch with us at camberroad.com, and we'd love to start a conversation. Even if you're not a fit now, it's good to develop the relationship. And as I said earlier, chances are, we might know a good solution for you if we're not the fit. And we welcome the opportunity to help. A rising tide lifts all boats in this business, right? So if we could be helpful in any way, we're happy to do so.
And for the founders, it's not just these two guys. There are people who does factoring. There are people who does, purchase order financing. So there are various other forms of non-dilutive financing out there. You just need to talk to your advisors, talk to your lawyers, attorneys, CPAs, bankers. they should be able to put you in touch with some of these providers out in the marketplace. And that could, I think end of the day, it's trying to figure out how to get your burn rate or your long or the runway extended to get to that next milestone, and making sure that you don't run out of money before you either raise or find another debt facility in place. Any other questions from the audience? I think we're almost coming up to the time. I'm like, Jimmy, any final thoughts? Any word of advice?
Yeah, my last piece of advice, because I saw Brex do this really well, and I've talked with lots of other founders and seen companies that have scaled to unicorn status that have also done this, but one of the most important things you can do in the early days is have that, not only a good founding team, but the initial few employees that help grow your company. They're going to be the ones that are day in and day out dealing with the product, your service, the customers, the sales, right? So being able to give them equity in the company, maybe that will take away from you ultimately as a founder, or will take away and kind of take up spots on the cap table, but having people that have that owner's mentality will scale your company to the next level. And so I would just say don't be shy with some of those early employees to give them a little extra equity than what you think.
Patrick?
Yeah, I think that's great. Echo the same. And just a quick shout out to all the organizers of Twin Cities Startup Week and Beta MN and all the volunteers. Thank you. We really appreciate, and I know it's a lot of work. So thank you for doing all the work that you do.
Well, thank you, everyone, and appreciate the time. And if you guys have any questions, please feel free to find Patrick, myself, or you can find Jimmy on Brex.com. Looks like so. Looking forward to hearing more from you guys and being part of this community. Thank you. Thank you, sir. Hi, Jimmy.
Thank you so much, Jimmy, joining us online. Thank you, Patrick. Thank you, Sanjeev. Thank you so much. Thank you so much for these non-dilutive options. A lot of times as founders, one of the things as a founder of color, one of the challenges that you have mentally is this idea of giving up ownership. And a lot of times you need equity, but you struggle with the idea of what does that look like. And so these non-dilutive options are just so important because it doesn't take away what we've heard earlier. It doesn't take away or a need for an equity round, but it means that you have a longer stretch. It gives you a greater runway in order to bring your idea to market, or if your idea is already in the market and it's performing, in order to reach those milestones that are just so needed. Earlier, we talked about, if you were here in the beginning when we opened, we talked about that Teddy Roosevelt kind of poem about the man in the arena, or for us today, the people that are in the arena. And we talk about that it's not the critic that matters, but it's the person in the arena, the person who, Teddy Roosevelt uses these analogies of marred in blood and sweat. When you think about an arena or a gladiator, that's the founder. So when we think about, and when we're talking about this founder track, it's the person who takes on the risk to be the entrepreneur. It's the person, again, who misses these birthdays and these holidays. But one of the best things that I would like to have an addition or change this man in the arena kind of mythology of this person who's doing it alone is the reality that founders are only as successful as their communities. Founders are only as successful as their partners. Founders are only as successful as their friends. Founders are only as successful as these resource partners, whether it's providing these non-dilutive options or whether it's investors who specifically recognize some historical challenges and want to take the extra mile in taking a meeting. Whether it is having Twin City Startup Week that brings an entire community together around the idea and the belief that the Twin Cities ecosystem can be the best ecosystem in the country when we work together.